You've heard renting is throwing money away. That advice is half right and half wrong. And the half that's wrong costs renters tens of thousands of dollars. Renting has hidden costs and hidden benefits the standard advice misses. 5 factors determine whether renting wins or loses for you specifically. In the next 12 minutes, we go inside the math, what renting actually costs you over 10 years, and the exact conditions where renting beats buying. The first hidden cost is rent inflation. Unlike a fixed-rate mortgage, your rent renews every year, every 2 years. And in most U.S. markets, it goes up, sometimes dramatically. The U.S. average rent has increased about 3 to 4% per year over the past decade. In hot markets, Austin, Phoenix, Miami, Seattle, the 2021-2022 pandemic boom drove 8 to 12% increases for several years. Though many of those markets have since flattened or declined in 2026, the fixed rent you signed isn't fixed beyond your lease term. The 10-year math, paying $2,000 monthly rent in year 1. With 4% annual increases, you'll be paying $2,660 monthly by year 10. Total rent paid over 10 years, roughly $290,000. Compared to your starting rent of $24,000 per year, you'll have paid 21% more in actual dollars over the decade. In high inflation markets during the pandemic boom, the math was brutal. Renters in Austin, San Francisco, Miami saw rents rise 50 to 100% in 5 years. Even with 2026's market correction, the cumulative impact remains. A $2,000 starting rent that doubled means tens of thousands more over the decade. This is why renting is cheaper arguments often fail over time. The mortgage might be more expensive in year 1. By year 10, the mortgage is the same, while rent has grown 30 to 50%. The fixed-rate mortgage becomes the cheaper monthly cost, which is exactly why banks love them. Rent control changes this in some markets. Caps vary widely. San Francisco at 1.6% in 2026, Washington State at 9.68%. Without rent control, the market dictates your annual increase. Most renters don't run this 10-year math when they sign their first lease. The second factor is one renters benefit from, but rarely calculate: flexibility. The ability to leave a city, change jobs, downsize, or upgrade without selling a house. That has real economic value. Selling a house typically costs 5.2 to 8% of sale price in transaction fees, post-NAR settlement. On a $500,000 house, that's $26,000 to $40,000 gone, plus moving costs, plus potential capital gains tax on appreciation. The total cost of moving from a house can exceed $50,000. Compare that to ending a lease. You forfeit your security deposit if there's damage, typically 1 to 2 months rent, $2,000 to $4,000. You give 60 days notice. You move. Total cost, usually under $10,000. The exit cost is at least 3 to 5 times lower than selling a house. This flexibility has measurable value for people who change jobs frequently, want to relocate for opportunities, are in early career or transitional phases, or have uncertain long-term plans. Locking $80,000 into a down payment and committing to 5+ years in one location reduces optionality significantly. The forced savings counterargument. Buying forces equity buildup. True. But equity locked in a house you can't easily sell isn't liquid. If you need that money, you can't access it without selling, refinancing, or HELOCs, each with their own costs and risks. Flexibility isn't free for renters either. They pay for it through rent inflation. But the trade-off has real value that the always buy advice never quantifies. The third factor, renters have hidden costs too. The just pay rent simplicity is misleading. 5 categories of costs that don't show up in the monthly rent payment. Renter's insurance, $200 to $400 per year, often ignored as small. Over 10 years, that's $2,000 to $4,000. Money that protects your stuff but builds no equity. Unlike homeowners insurance, it doesn't even protect your investment. Application fees, security deposits, and moving costs. Each move costs $2,000 to $10,000 in upfront fees. NYC renters historically paid 12 to 15% broker fees on top. But under the 2025 FAIR Act, those fees now fall to landlords for most listings. Move every 2 years over a decade, and you've still spent $15,000 to $40,000 on transaction friction. Lifestyle costs of mobility. When you move often, you rebuy furniture, pay for parking permits, register vehicles, set up utilities, lose security deposits to wear and tear charges. These aren't dramatic individually, but compound over time. Tax disadvantages. Homeowners can deduct mortgage interest and property tax with limits. Renters can't deduct anything related to their housing cost. This represents a real tax disadvantage worth $1,000 to $5,000 per year in some tax brackets. Rental property managers raise rents based on what tenants will tolerate. Long-term renters often pay above market rates because the alternative, moving, has its own costs. The market rewards landlords for this rigidity. The fourth factor is the most powerful argument for renting strategically: the opportunity cost of not putting money into a down payment. This is where renting can win the financial math, but only if you actually invest the difference. The setup. Imagine you would buy a $400,000 house with 20% down, $80,000, plus closing costs of $10,000. Total, $90,000 cash that would go into home ownership. As a renter, that money stays liquid and can be invested. The math: $90,000 invested in S&P 500 index fund, earning the historical nominal average of 10% compounds to $233,000 over 10 years. Inflation adjusted, the real return is closer to 7%, but the numerical gap from house equity is still significant. Locking that money in home equity costs you the difference. But this requires actually investing the difference. Most renters don't. They spend the difference on rent inflation, lifestyle, or simply don't think about it. The invest the difference strategy only works if executed with discipline. Without that discipline, renting just means you have less wealth to show for the same housing decade. Compare that to home equity. A $400,000 house appreciating at 4% per year is worth $592,000 over 10 years. After mortgage paydown, at 6.38%, you've reduced your loan balance by about $50,000 over a decade. Your equity gain is roughly $162,000. Real money, but less than the $233,000 the index fund alternative would have grown. The investment opportunity is real, so is the discipline required. The always buy advice exists partly because most people will spend the difference, making homeowning the better default for the average person. The fifth factor brings it all together: the conditions where renting actually beats buying, based on the math, not on dogma. Condition 1, short time horizon. If you'll be in an area less than 5 years, transaction costs of buying and selling typically exceed any equity built. The math favors renting almost always under 5 years. Condition 2, high price to rent ratio markets. In cities where buying costs 25 to 40 times annual rent, San Francisco, Manhattan, parts of Seattle, and Boston, renting and investing, the difference often wins financially. The price to rent ratio reveals when the housing market is overvalued relative to renting. Condition 3, disciplined investor mindset. If you'll actually invest the down payment difference into S&P 500 or similar diversified portfolio, the math can favor renting. If you won't, if you'll spend it on lifestyle, buying enforces savings discipline through forced equity buildup. Condition 4, high flexibility need. Career mobility, dual income families, expatriate situations, uncertain life stages. Flexibility has measurable value. Locking $80,000 into a down payment reduces that optionality significantly. Step back, 5 factors: rent inflation, flexibility value, renters' hidden costs, investment opportunity, specific market conditions. The always buy advice fails because it ignores all 5. The math actually favors renting in specific situations, and you need to know which ones apply to your specific decision. Owning isn't always smart. Renting isn't always wasteful. The right answer depends on your specific market, time, horizon, financial discipline, and life flexibility needs. Run the math for your situation. Don't run someone else's. This is the renting view. In our next deep dive, we go inside everyday banking mechanics, why your bank pays you 0.5% on your savings while charging 25% on your credit card, and what they're actually doing with your money. Subscribe to Money Unwrapped. We're decoding the hidden math behind everyday financial decisions, one mechanism at a time.